Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor or you want to be a multifamily investor, maybe you've been in the industry for a decade. This is the podcast and the YouTube show that we've really crafted and designed just for you. What we're doing is bringing all the latest and important research reports, articles, and then a couple original ideas and commentary from the Gray Capital team, all about the multifamily industry, real estate, and the economy to you, so you can make some really well-informed decisions. Some great reports. On the report tonight, we've got a piece from a mortgage professional about what's better, buying existing or building new. That's an age-old question. It changes in the market, but we're going to be diving into it. But also, big story on CPI inflation data coming out this week. It's running hotter than what the market had predicted, and it sent shockwaves not only through the equity markets, but the bond markets. And with the Federal Reserve going to be announcing another rate hike coming up, we have people forecasting 75 to 100 basis point increase. How's that going to affect real estate and the multifamily market? We've also got rent reports from Yardi Matrix, a great article from GlobeSt, and so much more. Joining us, Matt Bosnagel, Director of Communications and Marketing, as he does every single week on the Gray Report. Matt, let's just get into it.
All right.
Welcome back to the Gray Report. Matt, a lot of big news this week. Markets are in turmoil.
Yeah.
CPI came out. Was it a Tuesday?
Yeah.
Tuesday.
Yeah.
And came out a little bit hotter, but not to the conclusion that we both made, or the comment was that kind of within the standard deviation. So it came in basis point.
You look at
more than two, I guess.
I skimmed over the summary of the CPI, and then I did some easy mental math, and then I ran out because I was proud of myself for the math that I did, and I want to tell everyone my hot take, because it doesn't look like, because when I drove on the way over on that morning that the CPI was released, I was hearing stories about it's hot. It is hotter than ever.
Yeah.
But it really is. It's within the normal standard deviation, and if you annualize it, then you get something that's under.
Yeah, I understand the point, though, that both from a seasonal standpoint, where typically growth is slowing after the month of August, not just multifamily rents, but just in general, it's just a slower time of the year. But also, the Fed has tried to dump so much water on the economy to cool things down and destroy demand. You would think that they would see some result of their attempts, and inflation's even hotter than it was, or it's still growing. They thought they were going to see some.
They thought it would actually go down.
They thought it was the growth was going to decline.
Yeah.
Matt, we're at 8.3% growth year over year. I mean, at this point last year in 2021, inflation year over year was already crazy. And so we're 8% above where we were back last year in 21. But another big thing to note is that a lot of this is driven by the rental market, housing. Yeah. Housing makes up 30%, a third. I think it's 30, 33 or 31, a third of the CPI. Yeah. We saw pretty big declines in energy costs, in fact. So a lot of, deceleration of the cost of energy, cost of gasoline. But even with that, we still have a strong CPI print. The other big category that was up was food, which is up. All foods up 11%, 11.4% just year over year, just 0.8% a month over month. So things are still hot. Yeah. And so then the question I think a lot of real estate investors are asking themselves is this is the tail wagging the dog? Is inflation going to continue to drive rents, or is rent driving inflation, and we're going to really see this slow down and we're really peaking? Our rents are kind of really at the peak of where they are.
So that is the question that I don't even have it in my notes, but it's at the tip of my tongue that I keep asking is, are we getting to a situation where everything is so expensive, not just rents, where we may see delinquencies, or we may see that people can't afford rents, and we may see that impacting rents just because people can't afford. Maybe the demand is there, but they can't afford it, so we start bumping up and it gets a real ceiling. That's like my worst case scenario.
Well, and I think that I think we are seeing that in the market. I mean, delinquency is up, collections are down, and so when that's going on, you have to ask yourself, do we keep pushing rents when not everybody can actually pay it? You know, are we at that ceiling? And you know, with wages, they're growing, but they're not growing at the rate of inflation. They're not growing at the rate of rent growth. And we know that rent growth can push wages, but there's a lag there. Yeah. And I think we're probably going to be in a little bit of a wage rent or wage price spiral a little bit. But you know, but it does seem like we're getting to be approaching a point of where it's a little bit more normal.
Yeah. Well, and what I think is interesting, and this isn't a report this is a report from several months ago that RealPage did on rent to income, because this is part of what I was looking at when I was writing the newsletter, is that we're at a place, at least for market rate rents, that the rent to income ratio was around 23%. And that was in July, but that's still not so long ago. And so 23% now, traditionally, they say that you should only be spending 30% on. Now, the problem is the lower the income, the more they really do spend on rent. So Class C properties are having higher delinquencies, having a harder time paying the rent, and especially the real category that is affordable housing, that has much higher. And if you look at overall, there are people that really are struggling to pay rent. And I read this, you know, in another Jay Parsons LinkedIn article. And this is a separate one than the one that I actually have that I have linked here. But the idea is and we've said this before, is like, we want more supply. We want more affordable housing supply. You don't have to go protest us, because we'll be arguing the same thing, that the government should support greater housing. And another thing too is it is a different animal. There is a system for affordable housing in America, and market rate apartments, which is like what we do at the Gray Capital more or less, is just like a completely different animal. It's independent of that.
No, that's definitely a good delineation to note for sure.
But yeah, sorry, to come back to inflation. I did, you know, like I said, I was going to work right as the inflation report hit, and I heard on the news that it was, you know, that it was just horrible. I was expecting to see, you know, YouTube thumbnails with flames in the background, and like, what, the inflation conflagration in the nation. That was my thumbnail idea. But essentially, you know, 0.1 is like, I'm not downplaying it to say like it's only 0.1, but like I said, if you expand that over to a year,
reaction.
Yeah, it's
not that big of a miss.
And I think you were really accurate, because when you gave the little summary today, you said, you know, markets were shocked, and there was the shock and the drama was in the market's reaction, not necessarily into the numbers itself. Yeah. And that's, you know, expectations are a huge part of investment and in the ways that the market was calculating things in. So. Yeah.
Well, because they're thinking about, and this was going to go to the next question I was going to ask you, is the reason for the shock is, okay, well, there's not going to be no moderation in the rate hike that's going to be going on next month. You know, I think it's in the next several weeks. Jerome Powell's going to announce the next rate hike. Before, people were thinking maybe a 50 basis point hike. Now it's 75 to 100 basis points. I mean, the market is immediately pricing that in. Yeah. And what, you know, since that's going to eventually affect, you know, the discount rate. And we saw the 10-year Treasury completely run yesterday and this week also. I mean, went up, you know, good 10. It was going up went from 3.3 to 3.4 in the matter of hours, really matter of minutes. And that discount rate significantly affects the valuation of all companies, but especially growth companies, technology companies, and it affects obviously the ability to finance assets. So whether that's real estate, infrastructure, really anything. And Jerome Powell, I mean, they've said they've got their crosshairs on single family homes and real estate. Yeah. They want to cool that market off. Surprisingly, even there's a universal opinion out there that the housing market's going to crash.
I know it is, but we've heard it for so long. Of course, it's going to crash, maybe, in 2037, and eventually something's going to happen.
Yeah, there's high interest rates. Now it's a completely different environment than 2008.
Yeah.
Cooling price, some sort of price correction. Well, that's probably healthy. I mean, prices are still up 12%.
Yeah.
And inventories are still incredibly low. Sales volumes have just completely fallen off, though. It makes sense. I mean, when you're looking at a 6% interest rate on a single family home, when your buddy just borrowed at 2.7%, well, two things. One, it's like, screw that. I'm going to wait it out because I hope, not me, but a buyer, that there's going to be some major correction in a buying opportunity. But while at the same time, you have everyone that bought a house in the last couple of years or refinanced at an incredibly low rate. They're not going anywhere. I heard a comment from someone saying, well, they're going to be underwater. Well, it doesn't matter if they can pay their mortgage. If they can make the payment, which is relatively affordable because of the low rate, they don't have anything to worry about. So the inventory, the amount of selling and the bloodbath that occurred in the last great financial crisis in 2008, because everyone was on these variable rate loans. And then when they adjusted, they switched to the new rate and interest rates did go up in 2008. People's payments went up significantly. You just don't have that same environment. Not to mention the lending standards are different. Yeah. So, it's just, could we see some sort of price correction? Yeah, probably. And we probably should see some type of, because things don't go up in a straight line. Yeah. Things all have to oscillate up and down. That's just how kind of physics usually works and natural things. But I don't think we're going to see a bloodbath, but it'll be interesting. So back to my question, Matt, what do you think? 75, 100 basis points. What's Jay Powell going to announce? What do you think?
I think 75. That's my dartboard result.
So too. I think so too. I think they should have done 100 like a couple months ago.
Yeah. Because
it's like, why wait? Let's just rip the Band-Aid off and get it over with. If you've got, the terminal rate you want to get to, just get there sooner rather than later.
And maybe one of the reasons why I'm not as concerned about this idea of the housing crash, is that apartments are going to be a little bit more resilient, so I don't have that direct fear.
Well, yeah, no one's buying houses. They got to live somewhere, so they're renting. Yeah.
And then the other reason is if it's caused by the Fed, then I'm hoping that maybe the Fed can just dial it back once they get it to once they get enough people, that are upset, enough like bad things in the economy, they turn it down and then they turn it right back up.
Well, and that's what you keep hearing more and more and more is, and as this happened, especially on Monday, I heard this, and then Tuesday we had a horrible day in the stock market, but the capitulation has not occurred to wipe out so much. We haven't had the pain yet to see a bottoming. People are like, I'm waiting for the pain. I think there was some pain this week. I don't know if it was enough though. I don't know if there was truly blood in the street and people saying, I'm never going to touch the stock market again. I mean, certainly not in real estate because we haven't seen the declines really. I mean, we have seen cap rates elevate a little bit, but rent growth is going so fast that it kind of offsets that. But that's what it'll be interesting to see if we finally get to that moment of some sort of capitulation, and it could happen at this next rate hike. If Jay Powell says, okay, we're going to do 100 basis points, then finally, maybe we'll get to that moment where we can just flush the rest out and kind of kickstart this cycle again.
Yeah, and one of the things that I thought was interesting is kind of going back to this rental thing is how are things reported and how lagging of an indicator is the CPI is like, and it is last month, but it also is like even that report that comes from last month, the effects of that maybe happened 2 or 3 months ago in terms of like the primary cause. So it's like really hard to
and then and so I want to show this LinkedIn post that Jay Parsons did from he's from RealPage, and he always has a really I think interesting opinion, and essentially his comments are relatively similar to ours, but he really gets into the very poor, what he says is the way that CPI calculates rents. The methodology is, quote, horrendous. And it could also be dangerous. And this is what he says. So housing is the biggest weight in the CPI. We said that earlier. It's around a third. Rent is double dipped, essentially. It's used for measuring not only rent, but also home ownership costs due to just their crummy methodology, his words. And then he's saying, essentially, if policymakers like the Fed believe that inflation is still trending up instead of down because of a bad methodology of rent, what are the consequences?
Yeah, that is really...
Essentially, we're looking at the wrong inputs. And if that's what we're using to gauge inflation. Now, his argument is that we have seen a slowdown because we have seen rent growth subside. We actually have seen some slight rent declines, which is a relatively not surprising because it's seasonal. We always see rent declines this time of the year. But since this is a lagging indicator, it's not capturing necessarily all that seasonality. But if this is the data point that the Fed is going off of, and it's essentially a BS data point, like we're not using the right data.
Okay, so I think that the simplified argument is basic, like the methodology that they use is flawed. What he says, it relies on over-modeling, low-sampled, very dated assumptions and fails to apply best practices on rent collection from the private sector, which I think is all true, right? But it's like we're going to have a Yardi matrix report that probably draws in more specific data, and they maybe have a little bit more skin in the game than the collections on CPI, even though it does determine the U.S. economy. But also what I wanted to say is, like, a few months ago, we did cover an article that included a chart of market rent growth, renewal rent growth, and CPI measured rent growth. And CPI was lagging behind all of the other trends. It was much less volatile than all the other trend lines, where everything was spiking. The best that CPI rent growth could do was like a gentle hill. But with that being said, like, you can see the history, whether it's accurate or not, you can kind of get a ballpark guess,
general trend,
because you see where it's going to go. And the thing that really sticks in my craw is the fact that it goes last, that we are measuring things that maybe happened a little bit longer ago, or at least are showing up in their chart from long ago. So like I said, given the general trends, this changes in CPI reported trends tend to be recorded almost at the same time that renewal rates are recorded, which is really far after when like new leases or even like the average kind of market rate leases are. So I just think it sounds ridiculous to say, but none of the companies that we get reports on, they don't want to be wrong. Obviously, the CPI doesn't want to be wrong either, but like, Marcus and Millichap, RealPage, Yardi Matrix, Newmark, Berkadia, Redfin, Zumper, CoStar, Colliers, they're all putting out reports. And they're all these sources of information. And one of the articles says, it's good to read different reports, but it's really frustrating to read reports that are this consistent CPI report that's always so much different than the ones we're seeing every day.
Well, Matt, you've done a lot of great work that's really made the Gray Report industry leader in multifamily intelligence is breaking down, comparing all these reports, because there's a lot of different data sources and you got to compare them, the methodology. So, I'd say if there's one place to go to kind of figure out what's going on, it's right here, and it's the newsletter that you can sign up for at graycapitalllc.com/newsletter. My
final point about the CPI thing is, even though there's criticism about how it's measuring, some of the rent growth, if it was like Yardi Matrix or if it was like RealPage, the rent growth that we see would be year over year instead of 6.3%, which is what it recorded. The CPI rent growth was 6.3% year over year and 0.6 month over month. Now, if we were going by RealPage numbers, it'd be 10% year over year. So we'd see a higher spike. Things might have more drama. There may be a reason why CPI likes this old, creaky, antiquated thing, is because it kind of tamps down some of the, but that, that's biased.
No, I think there's probably some truth there. Okay, Matt, if you're ready, let's hop into this Yardi report. Let's kind of see what, like a private source, Yardi Matrix, Yardi, they're a huge property management software company. So they get all this data from all these different, large apartment communities that are using their property management software. And they're really almost more of a data and analytics firm, just as much as they are a software firm. Multifamily rents finally hit a wall in August. Presaging a deceleration that may extend through the second half of 2022. And the economy, they say, is starting to feel the effects of higher interest rates, while migration is slowing and the increasing lack of affordability is affecting high growth metros. Rents decreased $1 in August to $17.18 a month, making the first time since June 2020 without significant growth. Year-over-year growth decelerated by 170 basis points, 10.9 nationally. Asking rents were up 6.6% year to date. U.S. occupancy rate still at 96%. But just about the single family sector continues to mirror the activity in multifamily. Average single family asking rent decreased by $2 in August to $2,090, while year-over-year rent growth dropped 170 basis points, up 9.5%. So, I mean, we're I think to Jay Parsons' point, we're seeing a deceleration.
Yeah.
And I think his point, what he said is like, if you're tracking this, you're seeing a deceleration in rents, which we kind of expect seasonally. We expected a normalization. And so the idea that an increase, according to CPI, that affects a third of all of CPI is up, is showing a signal, talking about something that happened in the past, making a decision for the future.
Yeah, you want to
maybe slightly misguided.
I agree. I think that would be my main complaint, and it is more about the lagging aspect, maybe less about the methodology, which also is questionable. Yeah. I thought it was interesting that this. I just want to repeat: this is the first time that monthly rents have decreased since June 2020, and that's a crazy run. Mm-hmm. And it said, and also, oh, sorry, what were you saying?
No, can continue. I was almost certain, and I guess it depends on the data source. I'm almost certain that I thought that there was a decline in December and January of last year.
Yeah, there maybe it was measured in some other places, and it was probably maybe flat.
I'm pretty
to
sure
a certain extent, as Yardi Matrix measured it. But I also think, and this is something that we've noted before, the deceleration in August was strongest in many of the markets that have had the most growth over the past 2 years, a sign, like you said, that affordability is becoming an issue. For example, year-over-year rent growth dropped to 7 to 8 percentage points over the last 2 months in Orlando, 16.9% in August, Miami, 16.7%, and Tampa, 14%. We can look back at some of these specific markets in a comparison with some of the other data that's been recently published, but they do share a real commonality, which is that some of these Sunbelt markets may have had great year-over-year rent growth, but if you scroll down to their month-over-month near-term rent growth, they aren't doing as well. For instance,
this is a short term.
Yeah,
right?
that's where.
Short term.
That's what's really and lately, for the past few months, as we've kind of entered a little bit of a different paradigm, I think, than 2021. Things have really started coming into view, and it's making it a little bit more important to look at this month over month growth and how, for instance, San Francisco is really making a recovery. It seems like when it comes to short term rent growth now. Tampa is still doing pretty great when it comes to the renter by necessity asset class, but overall, it is not. It doesn't have a positive rent growth. It's on the bottom side when it comes to all asset classes. In terms of the most declining rents, places like Atlanta, Charlotte, Phoenix, Sacramento, even Tampa and Orange County, they're all not doing pretty well. And Raleigh and Seattle are among the lowest. They are recording the strongest declines in rent, both month over month. And if I am not mistaken, they also are among the lowest in year over year increases.
Yeah, no. So those are some of the top, growth markets that we've been tracking. I mean, Tampa and Raleigh. I mean, and then also the Inland Empire. I mean, the Inland Empire, just outside of Los Angeles, was just on a tear for the longest time, and we're finally seeing some pullback.
What's interesting is seeing Chicago, and just to return to Seattle. Seattle was one of those places where it seemed like people were moving out of at the beginning of the pandemic. So it's not like the San Francisco. It hasn't had that bounce back yet. And also kind of Chicago was limping along, not necessarily showing the stable strength in the Midwest during the pandemic, and it still hasn't yet recovered.
Yeah, a very good point.
I could talk forever about these little month over month increases because they change all the time, and ultimately, you get proven wrong the next rent. So there is a little bit of take the month over month with a grain of salt, but it's fun.
Yeah, no, and again, seasonally, we typically see a slowdown, but there's a lot of other forces. I think affordability is a big one. Yeah. So just supply demand demographics. Talking about migration. U.S. population growth is slowing. Multifamily demand will increasingly be driven by other factors such as migration, household formation. If there is a recession, household formation goes down. So that could be a potential headwind in the near term. A new Harvard study, though, is reporting that there has been a post-pandemic shift to suburbs away from the most urban areas. Surprise, there. And I think that's pretty sticky as millennials get a little older. They start having kids, need a little bit more space.
I was going to say, that was a pandemic. That was more like a persistent trend.
Well, I was gonna say, I think the move to the suburbs was happening before the pandemic, but then the pandemic hit, and it was just like just a full on acceleration, like many other things.
But I do think it's notable they're not coming back necessarily to urban areas. I think what's happening is maybe new young people are moving into urban areas and making that market grow. But it's not just like a return instant thing.
Yeah, in general, I mean, it's the urban areas. There are some that have fully recovered. I mean, like the New York cities, I know are really coming back. But a lot of other downtown urban cores, I mean, they have partially come back, but not nearly the same, especially because there was so much, it was such a popular investment theme to invest in the urban cores. And that trend is just, it's not there where it was, 5 or 10 years ago. So there's so much supply that's come online, especially in like downtown Indianapolis. And that's where the bulk of supply has been delivered and still is being delivered. But all the growth and demand is in the suburbs where there is some supply, but not nearly enough. Of existing or new. So certainly a shift. And we've been focusing on the suburbs for a while as just it's made a lot of sense. So single family build to rent segment, rents moderating for single family rentals as well, but still really pretty strong. But a lot more uniform in the single family space than in the multifamily space, as we can see. But I mean, these, very strong. I mean, Washington, D.C. and Orlando are just double everyone else, which is fascinating. That's year over year. Occupancy change, single family rentals, Philadelphia and Houston are taking the top there. And then just final piece on this Yardi report, Matt, that I want to touch on is looking at employment and supply trends, year over year rent growth, and then job growth. Orlando, which was a lot of rent growth. We've seen some recent declines, as we just mentioned, good employment growth. Indianapolis, again, we talk about Indy a lot because that's where we're from. That's where we have a lot of our properties we're in the top 10 actually year over year rent growth. Because again, many of these Midwestern markets just kind of they're steady Eddie. They kind of keep on growing at a linear pace. They're not as volatile. So you don't see the spikes, but you also don't see the troughs, and pretty decent job growth. Across the board.
And when it comes to completions, we are on the low end of completions as percentage of total stock that are planned through.
Yeah, that's a great point. I mean, that's kind of indicative of the Midwest in general. I mean, Indianapolis, we've got 12.5% rent growth. We've got 4% job growth, but only 1.5 completions as percent of total stock. You can compare that to in Nashville, where 14% rent growth, but they got 4.4% completions as percent of total of stock. And Orlando, almost 17% rent growth, but about 4% completions as percentage of their total stock. So again, you got to pay attention to the demand drivers, but also how much supply is coming online.
Take a look at Seattle. I want to see what
Seattle's looking like. Let's see.
Okay.
So Seattle, 11.5% year over year rent growth, 6.1% year over year job growth, and then a 4.3% completions as a percent of the total stock.
Wow, so that's like 3 times more. Some of these are pushing, like Austin's pushing almost at 5% of the total stock is these completions. That's interesting.
Yeah, no, it is fascinating. Next on the report, Matt, there's some markets out there that might concern multifamily owners. Please, according to GlobeSt.
We were talking about some of them for sure.
Let's talk about some of those. Matt, so what should we be concerned about? If I'm a multifamily investor, what do I want to?
So I'm mentioning this report, and you'll get these in like a GlobeSt or BizNow, which are publications that often will report on the reports, and sometimes I use them.
That's not what we do, is it?
No, we offer commentary and intelligence.
Yeah, there we go.
But I'm telling you, I like this one, and sometimes I like a little bit of what we say because we can point out things, right, that people aren't noticing. Yeah. Okay, and this is what GlobeSt did. They've got, we've got 3 decent multifamily reports that came out this week. They all cover the moderation and seasonality that's returning to the apartment market that we didn't see at this time last year. But GlobeSt's take on this, it does acknowledge the seasonality angle, but they also, I really liked it because it's a reminder that different cities are experiencing far different rent growth trends right now. And it's worth paying attention to the way these markets are moving right now. I also like the idea at the end, they say it specifically like, you got to read different reports. They're going to tell you different things. And that, you know, this isn't also this isn't in the GlobeSt article specifically. I mentioned this before, but I think that the post-pandemic, post-2021 multifamily markets finally coming into focus. We have come out of this hypergrowth period of 2021, and we have also kind of come out of this uncertain period of earlier in the year. Yeah. And we really kind of are in this part where, yeah, maybe things are moderating or even slightly decelerating, but things are really clear and a little bit more explainable in terms of rent growth and demand than it was before. You know, it used to be, last year around this time, we were thinking like it was hard to plan because you don't know. And also maybe a seller is going to get really excited and expect huge rent growth. You get a huge price. Are you going to overpay? And it's way hard to make predictions in that kind of a market. And when I see things are a little more predictable, it makes you a little less worried.
Yeah. I mean, because when you're trying to determine if there's 20% rent growth,
yeah,
what do you assume the next year or the year after? You're not going to assume 20%, or do you? Do you do 10? 10 is, more than 3 times more than your average organic rent growth.
Yeah.
But 3% isn't the option either. So there's a lot more speculating on events that no one knows the answer of. To have the right answer, you have to know more than the smartest traders and investors in the world, and people who have way more information than we do. They don't know where the bond market's going, where the economy is going. We can kind of get a feeling. I mean, my sense right now is just given more information, we're seeing a deceleration, and again, really a normalization. I think we're going to see maybe a little bit more than half of the rent growth we saw last year. I'm assuming maybe we see half the rent growth next year that we saw this year.
Yeah.
So in the 5 to 6% range, which is still elevated and almost double what you'd see on a normal year. And then probably relatively elevated levels, because we'll probably see some just tag along inflation, hanging on inflation. So maybe we're going to be in the 4 to 5% range for the next couple of years. But that's there's a much less degree for error if you're in between 4 and 5 than if you are in between 5 and 15.
Yeah, that's like the whole assessment. I think we are in a different paradigm in it. And what I was going to ask you earlier was, well, how do you make these decisions? We're currently pursuing like a number of properties right now, and like we're kind of coming out, but there's still so many question marks. How do you deal, especially when it comes to like, well, you don't know what the interest rate is going to be, so why even buy? Why do what we're doing? Yeah,
well, I think you have to be very selective. What we're looking at right now is where can we find value at a good price in places that maybe not everyone else is looking. So obviously the Midwest is our niche. So some secondary and tertiary markets in the Midwest that, again, don't hit the headlines, aren't a part of the normal narrative that everyone's talking about. And then finding opportunities to where we can still use positive leverage, which means your cap rate is higher than your interest rate, which the inverse negative leverage, no one ever hardly talked about before 6 months ago, because your interest rate was always lower than your cap rate. Now, a lot of acquisitions are your interest rate is higher than your cap rate, with the idea you're going to get growth, you're going to grow out of it, and your yield on cost is going to be more than your interest rate. But that when you're using negative leverage, it's not helping you because your unlevered yield is actually more than your levered yield. Now it helps obviously how much money you have to bring to the table, et cetera, et cetera. But so the couple strategies: one, find that positive leverage. And, we found a great opportunity in a tertiary market, in a great submarket of this market, that maybe not everyone would go to, but we know the market, we know it well, we know the submarket, and we're getting like a 5.7% cap rate, when with our interest rates now are anywhere between kind of 5 and 5.4 right now, and at least using like a fixed rate based on the 10-year Treasury, we still have positive leverage there. Another strategy that this isn't just something you can do; it takes more work, but finding opportunities with existing assumable loans. So we actually have two opportunities in our pipeline where we'll be assuming the loan. It was taken out agency loans with 10-year terms. They were taken out 3 years ago at a higher loan to value. I think originally they were at kind of the 75 to 80% LTV range. So today, the way we're purchasing them, they'll be right at 65% LTV, which isn't about the range that a new loan would be today, given the rates in the market. But the interest rate we're assuming is a 3.4% interest rate. Again, if we went out to the market today to get us the same loan, well, you'd be paying a 5.5% interest rate. So we're saving up to 200 basis points on the rate. And that is huge. So that allows us to, these are like A-class nice assets. So that allows us to buy still with positive leverage. Like these deals still are kind of like mid-high 4% cap rates, but our interest rate's only 3.4. So we've got positive leverage. So you have to be more discriminating. And you have to find these unique opportunities. It takes a lot more time. I mean, I went through our acquisition pipeline for the year. We've underwritten like 150 deals just to find a handful that actually work. Another thing, though,
I wish that was spread out over the time rather than all at once.
That'd be something. Another piece is I think the strategies have changed, and where value add isn't the same as it was a couple of years ago. You have costs that have gone up considerably. You have a struggle finding the labor or the contractors to get the work done. But at organic growth being at what it is, the ROI of a value add renovation where you're going to put a lot of money into a unit for a rent bump, the ROI is not nearly as attractive compared to some of the organic growth that you can get with doing much less. Because if for example, and this is a real example, we have a property up in Michigan where the lease trade outs were getting $150 more in rent. Our pro forma was to go in and renovate the units to get a $250 premium after the renovation, after spending about $7,500. So do you spend $7,500 to get an additional, to get $200 a month, or spend almost nothing, clean it up, and get $150? I mean, let's say you're spending $1,000 to get the $150, just a little bit of cleanup, or $2,500. Divide that by the $150 times 12. Versus having to spend $7,500 divided by the $200 or $250. The ROI is just not there. So it's much more efficient, but you're getting so much rent growth with just doing less. So you're going to work a lot harder, spend a lot more money, might not get it done on time, and you're only going to force so much appreciation. And there's a lot more moving parts and risk associated with those projects. Like we can do those, and we have value add projects that we're in the middle of. But on new acquisitions, we're saying, hey, what's a quality asset in a good location that we can buy at an attractive basis, because there aren't as many buyers, so like you can find some unique opportunities.
So value add projects are a little bit more competitive among buyers?
No, not necessarily.
Okay.
I mean, I think there's others that are going towards value as well. But the value just, they're not as, there's a lot of value add deals that aren't even trading right now because people are looking at valuations using a 4 cap that may have made sense 6 months ago, and people are looking at it and they're like, I'm not even gonna be able to get the work done. I'm gonna have to pay up from a 70s vintage asset. Why would I buy a 70s deal that I'm gonna need to put a bunch of money in, do a lot of work? I'm not even gonna get the contractors to do the work, and I have to pay a huge premium on that versus buying something that's built relatively recently that I'm gonna get great growth. It's going to be a good location. It's going to be a great property in the next couple of years, and you're always going to be able to command a premium. That's where more investors are looking at right now. And that's reflected in some of the surveys we've looked at in the past several weeks.
That's true.
Where workforce housing just isn't nearly as popular as it was several years ago. Now that'll switch at some point, but the other reason is because there's not enough wage growth in that kind of bottom quartile in workforce housing to support much more rent growth. Whereas on the A class, going to B plus through A class, we have all these people who like are making good money. They've got good jobs. They were going to buy a house, but they no longer can afford the house, or they said, well, I'm going to wait for the housing market to crash, and so I'm going to rent in the meantime. So we've got all of these people with good incomes looking for a nice place to live, and they're living at these A-class assets.
Yeah, no, that makes sense, especially, you know, as a real sum result of all the trends that we saw. There's a lot of the trends of 2021 in terms of renter behavior that haven't gone away.
Yeah.
Maybe the numbers behind it of like rent, you can't just keep growing, but like the desires and the demands of renters, they're still interested. Like we said, they're still living in the suburbs. They still kind of want those things.
Yeah.
Got a little sidetracked, but
it's okay.
I appreciate that discussion.
That's okay. It's been a long, interesting day. So forgive me if I go from here to there. RealPage, apartment rent growth continues to moderate in August. Similar story as that we've seen. And again, I guess it just goes in sharp contrast to the CPI report that we mentioned earlier. This article is by Jay Parsons from the RealPage housing expert that we quoted on LinkedIn earlier.
So we got 3 reports that came in, and I'm going to give away the CoStar. CoStar has us at a 0.1 decrease. Yardi Matrix has us at a 0.1 decrease month over month. And RealPage is a little different, has us at a 0.4% increase a month over month between July and August. So that's just kind of put that into context. And they are still saying that it's moderating. And I think, you know, that's probably really appropriate. Year over year, we're still at what did I wrote here? We're still at a dang high 10.5%. Now, as we continue with this slower monthly rent growth, I'm guessing this year over year rent growth is going to get lower, but we'll still end up well above historical averages. Yeah. Now, here's a great quote that I really loved. It says that, and it also really touched my heart, because I don't like when people say, I say, don't call it a cool down. And he says, there's a lot of panicky, it's a big slowdown analysis right out there. But remember, nearly every major rental owner, operator, and analyst expected to see moderation in rent growth in 2022 compared to the historic peaks of 2021. Demand and pricing power are not evaporating for rentals like we've seen in for sale housing in some parts of the country. Apartment fundamentals are still very healthy and should continue to be. Apartments are just trending more towards more sustainable balance. I think that's really important. And another thing, what I really want to, if you look at this chart of year over year rent growth as it changes, not that one, but the one, yes, this one. Okay. So for the listeners out there, you can see this big crest that really peaked in February 2022. And right now, and I'm just like this idea of, you know, usually when you get a really big year, the next year is a little bit lower. We are actually falling on, so we had about 10.5% rent growth in August 2021, and we have 10.5% in August 2022. So there's some like the good news about this is that like the demand is such that it's really sustaining. Like maybe the market does want to kind of correct for this like hyperventilating growth of last year, but it's doing so at a manageable level.
And this is also year over year. So to achieve you know, similar rates of increase, we're talking about a compounding over last year's incredible growth. And so to think that, again, it's all perceptions and how you're looking at it, but to think that to describe things as a, you know, cool down because we're not growing, we're not compounding another 18% year over year. Would we want to see that? I mean, that would be insane.
Yeah. And that's another thing too, to think about it. You know, it's easy to grow when last year you had negative growth, you know, but it's much harder to grow when last year you had a lot of growth. That 2021 10.5, that was that was boosted because
because of 2020. Let's go back. You know, that's a great point. It's these base effects that we've gotten so familiar with because of just the huge swings. It's a lot easier to grow. Yeah. To your point, Matt, 10% when you're growing off from previous years a negative, but then when you've had a 10% positive growth to grow another 10%, again, that's a big ask. And just the fact that we're still are at 10%, you know, year over year rent growth, depending on who you ask, that's compounding. That I think that shows a lot. And then so to compound, if we're compounding, you know, again, 5-6% next year, it's only 6% year over year. But again, that's compounding on top of an incredible amount of market rent growth, which again, as we've said, there's a lag between the market rent growth or the asking rent, the rent that's posted online, to when everyone at an apartment is actually paying that, because it doesn't grow. Renewals increase at a lower rate, and so it just takes time for people to get up to get up to market. So there's a little bit of nuance for sure, and the fundamentals do seem very strong. And just to show Jay Parsons' quote. Yep, there's a lot of panicky. It's a big slowdown analysis out there, but remember, so this is a great point that you have made.
Maybe what are they called? Is it Cameo? Where you buy someone, then they record like a short message.
Oh, the app. Yeah.
I want to get Jay Parsons.
Is he on?
No, he probably isn't. But I'd love to have someone just say it for me. Don't call it a cool down, and I could just save that.
There's a random people. Most people I don't know who they are. What is the mooch? Scaramucci. It was on there. I was one time just looked to see, and you could get like Anthony Scaramucci to do a cameo for you for like not that much money. It was like
some people do it for fun.
We'll start one. So I was like, we'll do it.
Another thing, just as to kind of close out this report, they do note, like they mentioned earlier, that Sunbelt is having a cool down, but markets seeing the least slowdown in growth tend to be steady Eddie Midwest markets like Cincinnati, not Minneapolis, Milwaukee, Cleveland, Kansas City, Columbus, Detroit, St. Louis, Indianapolis.
I think that Minneapolis was an oversight.
I truly do.
Because Minneapolis,
it's one of the ones that
an appropriate way to.
No, I kind of think it's like a little bit of a tragedy.
It is. Yeah. It is. It is a in many ways for like so many layers of tragedy, which we don't have time to get into on this report.
I particularly like that quote because they said steady Eddie, and that's something that we kind of say too.
We do say that.
I know it's unconscious bias. I think that we're in the milieu now. We're part of the zeitgeist.
Yep. Okay, CoStar, Apartments.com releases August 2022 rent growth report. Apartments.com is, if you didn't know, owned by CoStar. CoStar owns a bunch of companies like LoopNet, 10X, but 5 or 10 other companies that they've consolidated over the years. So Apartments.com is the leader in the ILS services, listing services that people are putting their Apartments.com to rent. Matt,
that's good, and like that's better methodology than we'll get from the CPI rent growth numbers.
Oh yeah.
And RealPage does like software and intelligence for apartment. Is that property management? as well?
RealPage is property management software.
So Yardi Matrix, and now and CoStar's kind of on more of like the acquisition side and helping buyers and sellers.
They're just like they're data. Well, CoStar, I mean, again, they have a portfolio of companies now, but their like flagship product, CoStar, is like a data warehouse of multifamily commercial real estate intelligence. I mean, we use it when we're looking at market. It consolidates market information, demographic information, market trends, and then individual information about properties. So a lot of just different market intelligence.
Just wanted to nail down, especially because this is sometimes the CoStar has a little bit more of a modest of modest figures, but again, they actually joined Yardi Matrix in reporting a 0.1 decrease in rents between this month and the last. All right. So the month-over-month numbers are about the same as Yardi Matrix. Has a little bit of a lower number for the year-over-year growth, which they say that that it is 7.1% year-over-year growth, which is slowing from the previous month around 8 point something percent.
Something like that.
What really was interesting is the numbers that they have for specific market rent growth. And again, Indianapolis is one of the top performing markets for year-over-year rent growth at 10.1%. The top one is Orlando at 12.8. We used to be seeing Orlando at 20s and 30s and 90s. But
again, this is compounding.
But that's actually true. Is like if you look at Orlando's like chart of rent growth, I'm sure it would seem like they're decelerating because they're not at the 20s anymore.
Exactly. It's cutting down. Growth is down 50%.
But they're the leaders of year-over-year growth, and I love that Indianapolis is in there. It is the top of all of the Midwestern markets. markets, but it is this, I think, really it's like prototypical sign of this Midwestern stability that we've seen.
They got to get out of there. We're gonna compress cap rates in Indy by 25 basis points, just again, which is like great for existing deals, but harder to buy.
Yeah.
So yeah, again, interesting numbers. It's interesting. I mean, interesting to see Indy kind of within the top 10 across a couple of reports. It always stays up there. Just the other markets are going up and down,
and like we said before, Minneapolis doesn't look like it's doing too well for year-over-year rent growth. And if you look over the month-to-month rent growth, let's see what they say. Minneapolis is still not doing too well.
It's negative 0.1, but like compared to any of these other markets who have seen incredible growth, Minneapolis is seeing the declines after seeing no growth and only declines over the last couple of years.
Now, this is really interesting. So San Francisco, I think the month-over-month rent growth is almost the inverse measured by CoStar versus measured by Yardi Matrix. And I'll have to look at that again. But this point, it decreased.
Definitely a discrepancy. Yeah.
Yeah. So, I've been telling myself this story that San Francisco is bouncing back, but I get, it totally depends on what report you're reading.
Absolutely. It does. Well, Matt, let's talk about this final topic.
Let's do it.
Let's talk. So this article is included on. So we do a little on Sundays. You'll get a little blurb from us, just giving you a couple reports that you may have missed during the week. Again, wanting to keep you up to date.
Mm-hmm.
Article that we didn't think much of, but ended up being the most popular article on that Sunday email, and that is investing in real estate properties versus new ground up construction. What are the pros and cons? This following article is provided by RCN Capital. So thanks, Nate Zielinski, for putting this article together. Let's talk about the pros and cons. I mean, so traditionally, and I guess maybe talking about the way I viewed it, and then maybe we'll get into Nate's Nate's report, is that first off, it totally depends on what your objectives and time horizon are. Okay. If you are someone who at all wants to see cash flow and income, ground up new construction really isn't a good option. Then what we have to ask ourselves are, what are the risk factors between buying stabilized and existing, and assuming that building new is higher risk. The reason for that is because it is a more complicated process.
Yep.
So like a lot of times you look at a range of different strategies in the risk and return profiles, with core being the lowest return, lowest risk, then core plus, a little more risk, a little more return, value add, more return, more risk, and opportunistic being the most risk, but you should get the most return. Development falls in that opportunistic category. You should get a premium on the risk that you're taking because, depending on when you invest, and there's different points of a development project where you can invest. You can develop the pre-development, you can invest, it's all entitled, ready to go. Because let's say you're buying a piece of land, the zoning isn't figured out, you can put money into it. Oh, no, you can't build here.
Yeah.
So you've got a piece of land that you can't build on, versus a project that's fully entitled, the permit's ready to go, zoning's in place, we got the contractors lined up, like
interesting,
turnkey, let's do it. There's less risk.
Yeah.
You should be compensated for the more risk that you take. So what we look at is there's more moving pieces to ground up development. Not that and there's also timing risks and there's not understanding what costs are going to be.
Yeah.
You have a pro forma and costs go up 20%, it can completely screw up your business plan. So the simplistic view that I look at it, and again, going back to this kind of core to opportunistic range, is as you kind of go up that range, there's just more moving parts.
Yep.
And more moving parts, more opportunities to break, higher risk. So again, like core, it's like you're not doing anything. You're buying, you're just letting it cash flow. So you're not forcing any appreciation on improving anything. You're not going to get much return because you're not taking much risk. There's nothing like, you're not going to miscalculate much because it is what it is. Then value core plus is like, we're going to do a little bit. We should get a little bit more return. But because we're doing a little bit of something, if we miss that, lower return. And so there's some risk involved.
Yeah.
Value add, same thing. So now instead of one moving part, there's two.
Yeah.
You've got to renovate some units, more stuff going on. Opportunistic, there's just another degree of moving parts. And again, depending on where that is in that stage, more and more moving parts. So the difficulty that as an investor, and I've invested as a limited partner, totally passive investor, investing with other people. And I've also been a syndicator, sponsor, GP, all of that. So when I've been an LP investor and looking at development projects, you're looking at total return. So there's not really going to be much cash flow. Maybe on the performer, they have cash flow, but the idea is that you're going to build it, call it 2 to 3 years, and there's going to be a capital event, either a refinance or you're going to sell it, and you're going to get all your money back, or you're going to continue to hold it if you refinance it, or you're going to get all your money back because you're just going to sell it. So you're going to wait 2 to 3 years, but that total return, your IRR should be higher than a value add project, certainly more than a core plus project. So when I'm evaluating a value add investment versus a ground up investment, that ground up investment needs to have a significant premium. The return needs to be in my opinion, needs to be much higher than a value add investment. So the value add investment is going to pay me from day one. I'm going to invest in it. At least the way we do our deals, you're going to get cash flow the next month, maybe the next couple of weeks. Ground up development, I'm going to give them my money. And it may be a 2-3 banger in 3 years, but maybe not. You invest with the right folks. They don't know how to quantify and mitigate the risk. You still have to wait for it. But let's say it's like, all right, I have full confidence in these guys. They're going to hit a 20% IRR, but I'm looking at a value add deal that's going to hit a 20% IRR also. I'm like, well, why would I take additional risk? Because there's inherently more moving pieces, assuming that the operators are equally competent in their...
that's what I was thinking is like, well, a lot depends on your familiarity with the people that are running it, but all things being equal, then like, why don't you do the thing that's less complicated?
It's all about being able, having a track record of success in the space, being tooled to execute on the strategy, and just the experience to know how to quantify and mitigate the risk. I remember when we first were starting, not wanting to do a big value add because I'm like, well, just I haven't done one and I don't know all of the pieces. And so I don't want to take that risk because it's an unknown. I can't quantify it.
That's exactly what I was thinking is like, if you're an expert at building apartments and you kind of wrap your head around it, you may think of that as less risky.
I know how to entitle it.
Yeah.
Investing is all about quantifying risks and getting comfortable with it when others are not.
Exactly. Yeah.
And that's what we do, the same thing, geographically in the Midwest, of where someone may not be comfortable, someone from New York City or Los Angeles or an international investor, they're like, Indianapolis, what is that? I've flown over it before. I've driven through it. It's not, people live there. The internet, they've got the internet there. Serious question that my wife Alex was asked when she went to school in New York. Were you raised on a farm, and do you have internet?
That's really funny.
And I'm like, yeah, you guys are definitely way smarter than we are. But it's like, I just don't know. So like, but we know. So it's all about quantifying risk. So that's my kind of...
Yeah. You know what? When I did that same exercise that you did before, before I dug into this article, I was thinking right off the bat about risk and how a lot of it is... I was thinking more about like the history of a property and how you can go in an existing property, you get pro forma, you know how it performs. And even though you might have plans to improve it, it's a known quantity. And for ground up developments, it's necessarily speculative a little bit. You can use, and they talk about this.
Well, it's market conditions in 3 years.
Yeah, exactly. They talk about this as
3 years.
And they say this is a benefit for ground up development in that you can use neighboring properties to kind of guess it. But it's still not the thing itself. But they do list the benefits. And one kind of
those. Bizarre. Again, I'm a little biased. You can make a ton of money developing.
It'd be kind of fun. That's one of the benefits he says, and
it's fun.
That's the first thing he says. Is like,
it's
if
fun.
You're creative, it's exciting. It's exciting. This idea to kind of have
build
this
like
creative expression. I said, what did I write here? If I just chose the color of the window treatments, I would drive by that every day and just feel so proud of like, oh, I kind of had a little bit of input on that one. So that's fun. But before he even says this first benefit, he talks about he's citing a Forbes article and says on a new development, there's a much faster recapture period, which is the length of time it takes to regain your initial investment. Once the construction is completed and the building is leased up, the developer can get a new loan in order to capture all its equity. So that kind of structurally could maybe counteract some of this risk question that's necessarily complicated. Now, again, if I don't know how to quantify that. I don't have those spreadsheets or calculations.
It's true. So, I mean, you're able to take a new loan out, you refinance the property, and oftentimes you can get very high degrees of leverage on new development, depending on your strategy. And the idea is if you're going to hold on to it, you completely refinance it, get all of your equity back plus some, and you can continue to hold on to it. Now, we've done the same thing with existing stabilized value add multifamily though. We've been able to pull out 100%, 130% of our capital within 18 months in the past. Yeah. We're getting ready to go full cycle after 18 months on, our condo deconversion Pinnacle and Meridian. It's going to be, 1.8, X, on everyone's equity after 18 months. So, I think as a general rule, like absolutely, it's more focused on total return, total appreciation. In theory, higher velocity every 3 years, just turning them over, making a big pop. But again, I think there's inherent a higher degree of risk because in a perfect world, in a perfect market, risk equals return. Yeah. Now we don't live in a perfect world, perfect market, but it should, and it often is related. But again, that's where I'm saying I better have a much higher return on the ground up than a stabilized existing. But the romance of ground up development, absolutely. Yeah. Putting your mark on a town, a city, having an idea fully materialize, putting together a whole team to get it done. It's something very attractive, and it's been something that so I guess we get asked this question probably on a almost daily basis of, do you guys either do ground up development, or when are you going to get into ground up development? And it's a different skill set from what we do. Yep. And so what I say is that at some point, we may get into it, but it's going to be a very deliberate and conscious decision to do it. We're not just going to say, oh, there's a piece, because someone will call me, or I get calls pretty frequently. There's a piece of land over here. You want to look at it to build? I'm like, I'm not just going to just jump out of some land that someone throws at me. We're going to make the decision. We're going to build. Yeah. And we're going to find the perfect spot. We're going to have a very specific strategy and build a whole team around doing that, not just figuring it out.
So that's a little bit of a connect. So that connects with another clear benefit that I hadn't really thought of. Now, we talked about the kind of speculation part. We talked about how exciting it might be. But this idea that you will be able to establish both rents and you can set the tone for staffing. You're not inheriting any problems. You have a little bit more flexibility with rent growth. You can set your own regime of where you think rents could be headed, where you want that to go. And you're not going to shock anyone because you're inheriting someone else's systems. And from just being able to have that level of control from day one and not having any kind of lingering problems that you don't know about, I think that's pretty compelling. Although, the cons are really, that could outweigh it.
Yeah. Well, I think that's definitely true. I mean, blank slate, start from the get-go, doesn't have any baggage. I mean, you can buy an existing property. It's got a bad reputation. No one wants to live there, and you have to rebrand it. Now, on the staff, you can inherit some not great staff. I mean, you always interview everyone before you take over a property. You can also replace all the staff at any point if it's not working out. And then, on the setting your rents, I mean, you got to still be within the market. If you have new development, though, you usually have the nicest, newest place. You can command certainly a premium, but average turnover rate at a multifamily community is usually around 50%, although it's elevated past year or so to 60%. So you're going to reset all the new, at least 50%. You're going to reset all the leases over a year. Everyone's going to have to renew, but 50% are going to leave. So you're going to sign brand new leases that you can set wherever the market is, wherever you want to bring them. And then in renewal, you technically could do whatever you want, but you typically are not increasing rent as much. But as much as that is a con, it's also a plus of you have an income stream. You're cash flow positive day one. Yeah. Not in a hole for 2 or 3 years.
Yeah, and that's a good point. That's to me it seems like the biggest risk of, and I remember saying this specifically at Gray Report, biggest risk of building something new is, what if you build it and they don't come. You know,
Yeah,
it's like you can do everything. You can be amazing.
But also going back to that, quick exit of getting out after 2 or 3 years. So for everyone that started getting permits for new multifamily development in, let's say 2020, 2021, what do you think their interest rate assumption was on their refi?
Yeah, well, and that's one of the cons that he says is this planning, and it's a lot of what you said. And I'm sorry, I won't cover all the cons specifically, but like every delay all of the cons necessitate a delay. There's planning delays. There is labor and materials delays, and there's just a delay because of the complicated nature of construction. And all of those delays layer on that the unpredictable nature of the interest rates, which have been, the more you wait, the higher they are, at least right now. That seems like a really, really big risk for ground up development.
And again, all of this can be quantified and mitigated. And if as not someone that does development on a daily basis, again, I'd say I have a little familiarity bias with buying existing, as obviously coming across, but it's the romance is definitely there.
So fun.
Yeah, it would be a good time. Matt, this is a great discussion. If you'd like to learn more about the multifamily industry, what we're doing over here at Gray Capital, pop on over to our website, graycapitalllc.com. We've got a couple deals in the pipeline you may have heard us mentioning. If you're a accredited investor, we'd love to have a conversation with you. We have a fund that's going to have a portfolio of 4 to 5 properties by the end of the year, 7 to 10 by the end of next year. A lot of different flexibilities inside the fund, but also some opportunities to invest directly into projects, a little bit higher minimums. Love to have a conversation with you. If you're not signed up for the Gray Report newsletter, you got to hop on over to graycapitalllc.com/newsletter. Hitting your inbox every Thursday morning at 8:30 in the morning, packed full of all the essential pieces of information to help you make the absolute best investment decisions. And then, subscribe to the YouTube channel. You're watching the video right now. You are at the end of the video, my man, my person, my woman, he, him, her, they, them. You might as well subscribe, right?
That's right.
You might as well subscribe, like, and share, because that helps not only whoever you're going to share it with, and sharing is caring, but also it's the algorithm. And it's going to pop us up in YouTube, and you're going to help someone else discover the light, which is the Gray Report, which is having good information about what you are interested in and what you're investing in.
That's right.
So we're here to help.